you. Share. So from digital money to sustainable investment. So today we'll be discussing developments in green products and capital allocation, regulatory developments, as well as client demands within sustainable investment. So I am joined today by Helen Avery, who is Director of Nature Programs at the Green Finance Institute and also head of the GFI Hive, Christina Church, who is head of Responsible Investment at BNY Strategy at BNY Mellon Investment Management, and also Anna Stupniska, who is Global Macroeconomist at Fidelity. So welcome all. Thank you so much for joining me today. So I think to start off, the first question I'll ask is, what are the key developments in sustainable products and sustainable investment tools, and how is capital and assets being allocated? And Christina, maybe I'll go to you first.
Yeah, I mean, I think that's quite a big question in terms of developments in products. I mean, I think we all know that sustainability is absolutely a focus area across multiple different products. I think what we're seeing at the moment is a move in the industry to see more, standardization of definitions. What are the different terminologies? What styles of products are there? What different investment strategies are there within the sustainability space? It's a very broad spectrum of different products, and often it gets lumped together and talked about as ESG, but with many people not really understanding what that actually means. I think we have seen in Europe that, a start, certainly in the investment industry, maybe started with exclusionary investing, selecting values that didn't align with a client's portfolio and excluding areas from those portfolios. But that's often now viewed as a little bit of a basic way of thinking about sustainability. We're starting to see more focus in the industry on a move towards more forward-looking impact measures to really drive sustainable investing. And that really is, still a pretty nascent or smaller part of the overall product suites, but certainly where we're seeing more and more client demand, where you can start generating measurable returns and measurable impact that's really very clearly demonstrated. And some of those rely on specific themes, and some can be more, broadly in the across, multiple themes to drive, whether that's environmental themes or social themes. I think climate has obviously dominated a lot of the headlines, and I know we'll talk about that a little bit, but certainly beginning to see a focus on broader spectrum areas of sustainability as well, within environmental issues. I know Helen will talk a lot more about the nature side of things, but certainly clients are asking us increasingly how they can think about bringing nature into discussions as well as climate. And then social discussions really rising on the agenda as well. And massive differences regionally, and we'll talk about the regulation a little bit later, but absolutely driven by regulation, and we're seeing big divergences between the way clients are demanding products in Europe versus Asia versus the US.
Yeah, absolutely. And certainly we've discussed the kind of divergence in regulation, market-led approaches versus regulatory approaches. And that's definitely something we can touch upon. Anna, lovely to have you here. What are your thoughts in terms of developments in green products, sustainable products, and kind of capital allocation towards sustainable investment?
Yeah, I think I will approach this from a research perspective. I'm from research background. What we can see is, or what we're trying to do is to join the bottom-up research and insights, where we look at obviously individual companies and we integrate environmental and social impacts into our ratings across companies. So this is our equity or bottom-up analysts focusing on. So moving away from just looking at how an individual company manages its financial risk with respect to ESG, to a much broader spectrum of risks with respect to environment, with respect to communities, to industries that they are in, and this relates to sort of the social aspect, the just transition. It's becoming much broader on the issuer level. And then on the other side, and this is where my role is, the macro research, so top down. Until recently, there's been nothing done on this front. So longer term forecasts, macroeconomic projections which go into capital market assumptions and strategic asset allocation. This is used to build any portfolio. This traditionally, and still is the case mostly, completely ignores climate change and climate scenarios. If you look at various transition scenarios, whether it's orderly by 2050 or disorderly, or whether it's no transition, and so we end up at a temperature increase of 3 degrees above pre-industrial levels, or the hothouse world, the impact on growth, inflation rates is so different across these different scenarios, and the uncertainty is huge. So using baseline scenarios to inform strategic asset allocation for portfolios in the industry, has been the standard, but it doesn't make any sense because it completely ignores everything that we know is already impacting, in fact, those projections. So when it's not the 2050, not the 2100 story, it's actually something that's happening today. And that's what I think we are not over that hump yet, but we are just approaching that change in the industry, partly led by central banks and regulators, and partly led by players like ourselves, who actually look at this top-down and trying to incorporate different climate outcomes into our SAA.
Yeah, absolutely. And I think scenario analysis and kind of risk is something that we can certainly touch upon, as well as the macro implications as well. I think that'll be very interesting topics to look at. Helen, as Christina said, your kind of expertise is more in the nature and the biodiversity element of things. So what are you seeing in terms of investment developments, product developments that are kind of helping nature and biodiversity?
Yeah, well, it's super nascent, as Christina mentioned, so there's not a great deal out there at the moment. And so if you look at each of the asset classes, in terms of opportunities, private equity, we're seeing quite a lot, but it's sort of more to do with circular economy. So you'd be investing in technologies that reduce overcatch, for example, or reduce waste. And then you have real asset opportunities. So there's a lot of funds that are looking at real assets in terms of sort of large scale reforestation, where you'd be selling some of the carbon as well, or large scale sustainable agriculture. Those opportunities tend to exist more in emerging markets, as well as the US and Australia, which have those massive landscapes. It's actually harder in Europe and actually in parts of Asia where there is sort of more small holdings in that large scale. So some of those funds are happening. And then on public equity side, it's really limited, as you can imagine. There is a fund that recently launched from ASN Impact Investors, and that is like a fund of funds. It's open to retail investors, and you can access the Rhino Impact Bond through that fund, for example. But as to my knowledge, it's sort of the one and only pure play biodiversity fund that's listed in public markets. And then on the debt side, there's some around sustainability-linked loans that maybe have some of the proceeds going towards sort of nature positive aspects. And again, some green bonds, some water companies have issued some green bonds where they're obviously looking at nature-based solutions. But it's pretty few and far between at the moment, which is a shame because, it's biodiversity loss is huge, and the other side of the coin, as we always say, to climate. So early days, but there is a lot of effort behind it to see how we can really start to embed things in asset classes. And some of that will just be through things like the TNFD, where we can sort of bring more clarity to companies and financial institutions around biodiversity impact and dependencies that will hopefully just shift behavior through supply chains to biodiversity positive, and then give us a lot more opportunity for investment.
Perhaps for those in our audience who don't know what the TNFD is, would you like to?
Oh, yeah, apologies. It's the Task Force on Nature-Related Financial Disclosures. So it's the partner to the TCFD for nature, and that's developing a framework that will be launched, I believe, end of next year. But they're releasing beta frameworks now every quarter.
So I think before we go into kind of client demands and thinking about returns on investments, it might be good to get an idea of the regulatory landscape and kind of policy requirements which are out there for sustainable investments. So how is that kind of impacting client demand, and also kind of what are the regulatory landscapes that are out there that investors need to consider? And Christina, I'll go to you first.
Yeah, I mean, it's very, very fast moving in the regulatory environment at the moment and a lot of changes. I think this summer in particular, we have 3 really big proposals globally on regulation that are out for discussion. In the US, it's the first time the SEC have come out with a climate proposal, which is incredibly far-reaching. It is focused on the corporates and ensuring that corporates disclose related to climate, and it will, at the moment, the proposal is linked to have it linked to the framework of the TCFD, which is bringing it more into international standards of frameworks. But yeah, that is, the first time we've seen significant regulation in the US side of the market. In Europe, certainly the asset management community are feeling the regulation very strongly at the moment. SFDR in particular, the Sustainable Finance Directive, is imposing a lot of change on the industry. It's starting to drive more classifications and making investors really think about what they want in their portfolios, and making asset managers really start to disclose more clearly what is in those portfolios so that they can align with what clients want. And I think that's very helpful. But of course, sometimes the regulations are not structured in a way that really deals with real world scenarios. And the European standards, to a certain degree, right now miss a little bit of the transitioning element of companies. A lot of companies that are, if we think about carbon, high carbon intensive industries, but that are looking to transition fast and looking for solutions to develop, and which drastically need the financing in order to decarbonize. Some of the structure of the regulations for the asset management community actually penalizes investment in some of those areas, or certainly doesn't make it easy with the classifications. So that's an area that the UK are coming in and looking to bring out more within their version of the regulation. But of course, that just adds complication. A different standard to Europe, no matter whether it's a better standard or not, is added complication. And then there is also the International Sustainability Standards Board, and now looking to bring more convergence globally in standards on disclosures around topics, again linking to the framework of the TCFD. So it looks like a lot of the standards globally are linking to that, but with still very early stages yet. So sometimes it's very hard to structure products with so much change happening in the industry to understand exactly, where, not only where client demand is, but to ensure that these fit within the regulatory environment. But we're seeing a huge push globally for much more standardization and more onus on corporates to disclose. The European regulations really started with disclosures for asset managers. Very hard to disclose what's in your portfolio if the corporates have only got to disclose voluntarily.
And one of the things we talked about before is how the US has kind of been a little bit behind in terms of regulatory approaches. We've recently seen, obviously, the US Securities Exchange Commission has really stepped that up and is kind of making big moves at the moment to kind of rectify that, I guess. Where do you think that's coming from? Do you think that's coming from the clients? And what's the kind of response been to that kind of development, would you say?
Yeah, I mean, the US is a very interesting market at the moment in terms of Europe. It's a very clear demand for sustainability. In the US, there is certainly the environmental angle is very much a politicized area. There are strong stances between the red states and the blue states in the US. There's a strong political lobby about whether integrating ESG into portfolios, into clients' considerations, is something that should be done. There, historically, rules brought in under the prior administration that wouldn't allow the integration of ESG into public pension funds. Some of those are being unwound by the current administration, but then you get certain states in the US that are coming out with strong stances around energy sector, as well. So it's a very sort of bifurcated environment in the US. So I think where the US is, where the SEC is coming from, is really trying to ensure that there's a lot more disclosure, a lot more understanding of what sustainability means, what ESG means, and what clients ultimately want. Because as you know, these portfolios are trying to align with client demands. As long as clients understand what those portfolios are, I think everyone can choose which element of ESG they want to integrate into those portfolios.
Yeah, no, absolutely. Anna, in terms of regulatory developments and client demand, what are you currently seeing?
I think it's interesting to, well, in addition, obviously, to what Christina talked about, to see progress within central banks. Again, you know, a year ago, it's not something that the Fed would even mention in any of the speeches or any of the question sort of Q&A type sessions. Now they are trying to catch up with the leading central banks like the ECB, like the PBOC as well, in terms of producing stress testing, obviously for the banks, also for non-financial corporates. That's something that the ECB has done, and the published results clearly pointing to a lot of vulnerability, particularly in Southern Europe, within those industries that are more that require to do much more to sort of decarbonize or high impact industries, they will be rolling out this stress test as a compulsory exercise. So I think that the raising the profile of this and the awareness sort of within the financial system has drawn attention definitely over the past year or so, particularly with the network for greening the financial system, and GFS, which is the network of central banks and supervisors, who have published and made public various climate scenarios, and this is becoming the industry standard. So we're seeing a lot of our clients actually using those scenarios for their own stress testing. We are seeing in terms of just as this regulation and this momentum, policy momentum intensifies, we are seeing different demands from our own clients. They are less interested in perhaps getting exposure to an ESG product, but more interested in, say, getting our help in finding solutions for them more generous and being flexible in terms of discussing values, their values, and how whether they coincide with our values, how we think about investment, how they should think about their own assets, their own business to meet their own client demands, how they should think about reputational risks related to sustainability. So I think the problem set for clients has become much wider, much broader, and our involvement as well has changed a lot, even sort of since COVID, which has accelerated many trends to some extent.
Yeah, absolutely. I'd like to come back to the risk element, but first, Helen, I'll go to you. Obviously, the nature, biodiversity elements are slightly behind, but we mentioned the TNFD. There is regulatory practice which is gradually being brought in. What client demand are you seeing? What do clients need to consider if they're integrating biodiversity in, and what regulatory frameworks are you seeing?
Oh, that is very early. I think we're all sort of waiting for the taxonomy in the UK, that is, to, obviously it's being developed, to sort of better understand it. And it's really a data issue for nature. The TNFD will obviously help provide that framework, as I mentioned, for companies and financial institutions to at least assess and then report on their nature dependencies and impacts. I think to this risk point, what we haven't sort of fully stressed enough or fully grasped enough is the material risk of biodiversity loss. So it doesn't really sort of encourage companies to sort of take a look at their own dependencies and impacts in nature. There's the Partnership for Biodiversity Accounting Financials as well, PBAF, that's helping financial institutions look at their loan portfolios and their entire exposure to biodiversity and the biodiversity impact. But that message of, is it really material yet? Hasn't quite gone through. So we're looking just in the UK to carry out a piece of work to like quantify that risk for UK industry, to show by sector what is your exposure to, you know, what is your reliance on clean water, and how are you exposed to risk. And I think once that message starts to go through, then we'll start to see regulation come through. On the other side, and that's something we don't talk about enough, I don't think, is that we're often talking about like macro regulations. We just carried out this huge piece of work with like 300 partners across the UK to kind of see what are the barriers to investing in nature in the UK, you know, whether it's you're going to invest through carbon markets or reduced flood risk, perhaps, like payments for ecosystem services type deals. And just there are just so many on the ground issues. Like nature is such a local issue, whereas, you know, reducing carbon feels like we can collectively all benefit if it's done globally. It's just not the case locally for nature. Not the case for nature because it's so local. So there are so many sort of regulations that are blocking nature markets from developing, that we're also focused on things like, you know, how the water companies, they have asset management plans that run every 5 years. It's not conducive to investing in nature-based solutions. So there's so much groundwork that has to come up at the same time, because we just don't have time, as this top-down regulation. So I just always think it's worth sort of considering the two, because they have to coincide.
Yeah, absolutely. So to go back to the scenario and the risk, Anna, obviously this is something that you've mentioned a couple of times. So what scenarios and impacts on long-term risk and impact on investment does climate change pose? And especially kind of looking at time horizons and the impact that plays on various jurisdictions as well.
So there are many different scenarios, and the range of outcomes is really wide. But if we just think about different, say, projections for CO2 concentration in the atmosphere, and that's something that the modeling, I don't do this modeling, but this is something that's done by the international climate community. Looking at various CO2 concentrations, then mapping it onto potential temperature increases. And this is where we get to sort of different starting points. Okay, do we manage to cap the temperature increase by 1.5 degrees by 2100? Do we manage to cap it by 2 degrees, or no, we don't. So we get 3 or more degrees, and then we move to hothouse world. And then within the climate community and macroeconomic community, this mapping, the temperature increase is mapped onto macroeconomic outcomes. So there's a complex, sectoral industry models, various approaches there, but ultimately we can split this scenario, say, in 3 different outcomes. So we get to net zero by 2050. The transition can be orderly or disorderly. We get to net zero maybe later, and also in a disorderly fashion, or we don't get to net zero by 2050, or at all, in fact, in this century. And so whatever outcome you look at, actually, the transition is costly, particularly if it's done over, say, the next decade or the next 2 decades. So you have to pay the price for this transition up front to then avoid paying for the physical risks later after 2050. If you do nothing right now, nothing on transition, so it's not costly at all, you don't pay the price, but after 2050 you pay the price in terms of extreme weather events, obviously rise in sea levels, etc., etc. So the scenarios are varied, and the impact across geographies is extremely different. So if we look very, very simply, northern versus southern hemisphere, northern hemisphere, actually a lot of countries benefit from a temperature increase, because the sweet point, well, from climate science, the sweet spot in terms of average temperature is 13 degrees. So if a country's average temperature, annual temperature, is below 13 degrees, then actually any increase in temperature would increase country's productivity and have a potentially positive impact on growth. If the average temperature is higher than 13 degrees, then any further increase in temperature would have a negative impact on productivity and growth. And if you look at projections which just take into account physical risks, so there's a risk from climate change, from rising temperature, then obviously all the countries in southern hemisphere really get wiped out in terms of GDP or GDP per capita by 2100 relative to what it could have been without climate change. So you see GDP, growth dropping by 100%, for example, in countries like India, Brazil. So there's a big countries that are really, really exposed. And so it's the trade-off between the transition, how much you pay upfront, and physical risks that, talking about time horizons, it's not happening right now, but they're very, very costly after 2050. And obviously you need, forward-looking and not short-termist, governments, regulators, companies to actually look over the long term and decide on that trade-off. Just I guess one thing to finish, when we look at different metrics, because this scenario, it's completely impossible to say what is it, what's more likely. We cannot say, let's make net zero by 2050 our base case and just base our assumptions on that. So we'll look at 3 different metrics, corporate action, what's happening on the ground, and we'll get this from our analysts. We'll look at policy action, what's happening in terms of regulations, central banks, etc. And we'll look at technology, because technology is something obviously that enables that transition. And so when we rank different countries and we come up with sort of probability assessment, we actually think that a disorderly transition to net zero is much more likely than an orderly outcome. That means it's going to be costly, perhaps later in this decade, very inflationary, by the way. We can talk about current inflation, and which is partly driven by net zero transition already. Very inflationary, costly in terms of GDP, particularly for those countries that have to pay much more now to decarbonize. And that means carbon pricing, global carbon pricing, and carbon price not at $4 globally, but at 200, going all the way to 700 or 800 over the next decade. So when you put this kind of assumptions in your model, you get very different outcomes, as I said, for macro and for investing.
Yeah, no, all very, very good points. Christina, do you have anything to add to that in terms of risk, but also what impact this has on investors who don't transition, who are not moving into more kind of sustainable investment models, and long term, what impact that could have?
Yeah, I mean, we're certainly seeing so many different demands for sustainability models, and climate being one phase of what people are focused on. And I think really what we're seeing when we're looking for investments and investment opportunities is we're trying to invest in those businesses that will be sustainable for the future. And that's when you generate sustainable returns. It's looking at those businesses that are doing the analysis that Anna was talking about, to working out those scenarios and looking to see where they can be best positioned under those different scenarios. And as we get closer to the end of the decade and working out whether there is more likelihood of a disorderly transition or not, trying to identify those companies that have woken up to the need to transition the earliest, those that have maybe spent on the cost side the earliest, or in sectors where the impact may be less dramatic. And I think when we think about climate, it is that balance between sort of climate damage and the need for adaptation finance, and climate mitigation, and can we reduce carbon in time? And then that will require very different investment requirements and opportunities. So it's a huge topic. And I think when we talk about sustainable investing as if it's a standalone, separate type of investing, really, this is just one more layer of education on standard investing that any investor should be factoring in these considerations when looking at, depending on their time horizons for portfolios, is that portfolio fit for the future? These scenarios are very important to understand that.
Yeah, absolutely. Helen, do you have anything to add to that?
No, I don't think so. So we're just super early days. To your point, just on what you don't pay for now, you're going to end up paying for later. I think we're certainly seeing that in nature, just on the climate adaptation side, which I don't think we talk enough about, making that connection between nature and the climate adaptation piece, which is coming. And maybe that's because we all don't want to think about it. We just still focus on mitigation. But we did just like a really brief piece of analysis on what the finance gap for nature restoration just for the UK was for the next decade. And at best, it's 44 billion, that gap. And at worst, it's 97 billion over the next decade needed. But the problem when we did that is the data just wasn't there to show, if you don't do it this year, how much is that cost going to go up next year and the next year and the next year. So it's just, I think we all need to sort of move as fast as we can, really.
Yeah, absolutely. I'm conscious that we're already running out of time before our break. I don't know if the audience has any questions. Yeah, we have a question with the gentleman over there.
Mark Burgess from ONFIF in Asia. Great panel. But one of the challenges, and I also sit on a large pension plan, we are very committed to this. It's Hester in Australia, you may know them. One of the challenges is getting the sustainability relative to the actually investing. The connection between the two on a 12-month or a 2-year horizon, and the interaction between those parts. And one of the challenges today is that a lot of money is coming at sustainability, it's coming at climate. It may be overpricing assets, it may not, but it's that interaction that actually then puts the money to work. How are you respectively seeing that inside your organisations? So the theories are working well, what we want to invest in, what we want to try and achieve is there, but the actual application of money when it gets to be invested. Thanks.
I would like to, Christine.
I mean, I think that's, there's certainly a theory that if you do invest sustainably, you're giving up on returns, and, thoughts around that, and that, that can often prevent the capital moving into the right places. And I think what we're starting to see is that understanding of, the urgency of the transition and the speed with which that capital is required, combining with the regulatory environment. And there is still more and more urgency required at a policy level to drive some of this finance into the right directions. Because without that, it's all very well for us as asset managers, asset owners, and wealth managers to want to move this finance into those directions. But without the support all around from the frameworks and the infrastructure and the policy support, if you can't see the returns, ultimately, the majority of these investments are not philanthropic investments. They are looking for returns. They might be willing to share those financial returns with impact returns, but there is still that requirement. And I think until we get that full support from the broader frameworks, we won't see it moving quickly enough.
Could I answer?
Yeah.
I just think it's such a great point that we're just not talking about enough. And I'm not plugging what my job here, but one of the things we do at the Institute is kind of say, you've got this global wall of money that we keep hearing about, but it cannot be deployed in practice. And why is that? So we kind of say you take a sectoral view, so whether it's decarbonisation of buildings, by your country, because it's all dependent on your national policy. In my case, I look at nature restoration and nature-based solutions within the UK. And then you have to bring every stakeholder to the table, not every stakeholder, but a cross-sector of stakeholders to the table to say, actually, what are the barriers? And it's just really surprising what the barriers are to actually getting that money moving. In some cases, it's just like, so I'm just thinking of peatland restoration in the UK, not enough skill set to go around to do the peatland restoration required. And inflation is also going to cause a problem. I mean, that's something that we can overcome, and then you can get the money flowing. And I think we forget that we sort of live in this financial world, that it's all about the real economy and how we get things moving. And then there are things like regulation has to change, and maybe we need sandboxes. And to the point on philanthropy, it's just massively missing. Like, we just don't have this pool of catalytic philanthropic money to kind of put to work, whether it's first loss or it's technical assistance on some of these pieces, or paying for, these coalitions to come together to bring stakeholders together and actually figure out what are the barriers, and then work with government and work with the finance sector. But unless we do what you're suggesting we do, I think we're going to constantly have this gap of the money not getting to the outcomes that we actually want.
Just to add about bringing all the stakeholders, that's why I was talking in the beginning, this move from just clients interested in products or investment managers just branding sort of ESG products, to actually getting sustainable investing and the whole approach with all the stakeholders embedded into the investment philosophy. And so this is the ideal situation that, 5 years or 10 years time, we don't have a panel on sustainable investing. We just have a panel on investing, but actually it is all with the sustainable philosophy in mind. We're not there yet, not at all. But I think we see it as sort of the endpoint where we want to get to.
Yeah, and perhaps to end on a positive, what opportunities do you as panelists think are out there with sustainable investment? And Anna, if you want to go first, you have the mic.
Opportunities in terms of
in terms of sustainable investment, driving the transition, and kind of moving that capital over towards kind of more sustainability.
Yeah, but I think we mentioned already a few things, but just transition is something that is going to, I think, to gain more attention. Obviously, something that the European Union is working on, but I think the realization and post-COVID and now with the war in Ukraine, I think everyone is quickly realizing that that's not going to be so easy. That requires money and commitment on the fiscal side, especially from the government, to spend on, for example, retraining, relocating, creating green jobs. So it's easy to talk about just transition and it sounds really nice, but it's really hard. And I think this is going to create a lot of differentiation across industries and across countries, with countries and governments who realize that they need to invest up front and achieve the just transition versus countries who are lagging behind. And that, in fact, I think will also create various opportunities for capital going forward. So this is just one of the things I'm mentioning.
Yeah, they're brilliant. And Helen, final remarks? And
on the nature side, I think there are plenty of opportunities. Well, there are some opportunities out there, let me be clear. The Natural Capital Investment Alliance is a group of asset managers who are looking and investing in natural capital, with chiefly real assets, but there are other opportunities there. I think if you have the opportunity to be more strategic with philanthropic capital and use it as impact investment, looking at low returns, but being part of a first loss tranche of a much, much bigger, more impactful fund. One wealth manager told us the other day they needed 20 million of that first loss to move 1 billion of capital into a major natural capital project. It's just so important. So I think just keeping your eyes open for opportunities. There are out there, but it takes a bit of a risk appetite, I suppose.
Yeah, and Christina.
Yeah, I think just following on from Helen's point on impact, I think we're starting to see that being more demand there. And I think if we start to see demand for impact and deliverables and KPIs that can really show what is being achieved with this investment, and if that starts to be embedded into the financial system, that is as important to show from a company as a standard profit and loss accounts, that's when we start to see that wall of money starting to really be able to be generated towards some of these important projects and places. So we're starting to see it happening, but it's still a huge amount needed.
Slow progress, but progress all the same. Thank you so much to our panelists.